Now, despite persistent credit concerns in commercial real estate, emerging cracks in the consumer, and some major store closures this year, our next guest says shopping centers have room to run, upgrading Regency to outperform and upping his price target to 67 from 61. Joining me is Haendel St. Juste. He's an analyst at Mizuho. Haendel, I don't know, you're leaning into the consumer. Some people say it's time to lean out. What do you think?
Well, first, thanks for having me. And look, I think to be clear, not all retail is created equal. So Regency is an owner of high-quality shopping centers, leading demographics with above-average incomes, density, a great balance sheet. So I think differentiation is required. We're certainly watching the consumer have similar concerns, but their portfolio also has below-average exposure to some of the segments that have been a bit more under pressure, less exposure to the Walgreens, dollar stores, movie theaters, gyms. So differentiation is important. And this is a name with an inflection in growth next year, trading at a discount to its long-term average. And so we think there's a real opportunity here for a bit of a re-rate, but also a meaningful growth ramp into next year.
Yeah, it's a little surprising because we hear about some of the shopping centers that are anchored by grocery stores, for instance. There's a couple of REITs with a bit more of that bias. This one is you can tell me, but they have some concerns over their tenant mix, Joann, Red Lobster, Walgreens. I mean, it's sometimes perceived as to be of somewhat less good quality or slightly more discretionary or both. Assuage those concerns.
Of course. So again, I think Regency is a name which has less exposure to some of those names that you outlined. And so as we think about the consumer, as we think about, obviously retail sales have been flat. We think about just the overall backdrop of slowing economy. There are going to be more, store closures, but I think the segments that these landlords are exposed to, when you think about the locations, again, the demographics, the incomes, the high income first ring suburbs, and then the tenancy. Publix is a major tenant of Regency. And so I think it's important to distinguish and keep those factors in mind.
Absolutely. I mean, that does seem to be a place where consumers, even if they're pulling back, have a more propensity to spend. Okay, this is also interesting because it comes in contrast to your note about kind of fading the apartment center REITs. And I think that might have catch a lot of people's attention, including the Fed as a side note. But what do you think is going on in the apartment and multifamily space? Further downward pressure on rents?
Sure. So I think where we are in mid to late summer, there's a seasonality to the apartment business. And so there tends to be a little bit of a sell-off or weakness in the back half of the year as we get to the tail end of the peak leasing season, which typically lasts between March, April through August. And so the sector, the apartments tend to do a bit better, a bit of a hope trade into the spring. But as rents start to level out and fade into the back half of the year, there historically has been some seasonality. And as we now get past those months, I think there is some concern about that, but I do think there are some names here which can still outperform over the next year, including CPT, Camden Property Trust, a Sunbelt-focused name where there is a lot of supply, but we're now lapping peak supply. The stock's really cheap. And by this time next year, we'll be talking about improving rents.
Oh, that's so interesting. So some counterintuitive takes on some controversial parts of this space. Haendel, really appreciate it today. Thanks for your time.
Thank you.
Haendel St. Juste on shopping center and apartment rates. Some opportunity there. We'll see.